Brendan, it's great to have you back. And the first thing I thought when I looked at Chinese internet names outperforming is it actually the classic stay-at-home trade?
Well, it is true, Rachel, that, in some ways, these companies are beneficiaries to lockdown policies. At the same time, the government is going to work to ensure that these companies aren't taking advantage of residents. So certainly we're seeing a little bit of outperformance, but I think some of that is just really driven by just Shanghai and Shenzhen, the A-share market, which had a pretty decent year in 2020 versus Hong Kong, U.S. names underperforming. We're seeing a little bit of a reversion between those two sets of Chinese equities.
So do you read into this? In other words, are these stocks rallying for good reasons or for bad reasons? Because sure, a K-Web investor might get a little bit of a reprieve if the internet stocks do well for 4 weeks as COVID spreads. But in the long run, I'm sure they would want a stronger Chinese economy, better earnings and profitability potential, right?
Yeah, 100%. That yes, they are in some ways a short-term beneficiary, but certainly the aggregate slowdown in China's economy would weigh on consumer sentiment, household spending. So, I think in general, what's happening is these names have already come down so significantly that the net effect is pretty de minimis at this stage versus the Shanghai and Shenzhen market, which were up 9% and 13% last year, are kind of reacting to the potential for the capital to experience the type of lockdown that we've seen in Shanghai.
So the simple question, I guess, for individual investors, not pros like you or people who specialize in, is China really investable?
Well, we're talking about the world's second largest economy, the world's second largest stock and bond market. So I think investors have to understand what's happening there. And that's obviously something we're very focused on here at KraneShares, Tyler. So I think, yes, it is investable. I think we've seen that there is going to be volatility to single country emerging market investing, and we have to volatility adjust our positioning to make sure we can ride out situations like we've experienced over the last year.
So how do you do that? How do you adjust that volatility? Is it by diversifying in other emerging Asian markets or what?
Well, I think first and foremost that the U.S. and Chinese economies are very intertwined. So you as an investor have exposure to China and broader emerging markets through great companies like the Apple and Nikes and the Boeings, which do General Motors, which are doing great business in China today. At the same time, there are going to be domestic players, particularly on the technology side, where there's less foreign competition. And so that's an aspect of how we've tried to build ETFs like K-Web to give you a unique exposure that you might not be able to get elsewhere.
You also, Brendan, now have the headwind of the weaker currency. What's going on with the weakness in the Chinese currency? Its moves lately have been as extreme as anything we've seen to the downside. Is it just a one-off phenomenon?
Well, I'm a big believer that interest rate differentials really drive the majority of currency movement. So you've seen the U.S. 10-year Treasury get up to that 280 level, which is exactly where a Chinese 10-year Treasury yields today. So it's more of the catch-up of the U.S. Treasury yields to where the Chinese yield is, and that's putting pressure on the currency. I think China will try to slow things from getting too far out of hand. They don't want to be labeled a currency manipulator. And so even after today's close, they made some adjustments to how much the banks have to keep on FX reserves in order to try to stabilize, keep this thing from spiraling out of control.
Shepard Smith here. Thanks for watching CNBC on YouTube.